Well, welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne. He is the founder and editor of the Daily Gold. Jordan, we're going to bounce around, talk about a number of different markets and how these are impacting the precious metals, as well as talk about the overall precious metals equities. Let's first start with the US dollar. Overall, the dollar is having a relatively good day today. In the morning, it had gone through a bit of a drop, but has pretty quickly recovered. And even after the peak that it had reached kind of at the tail end of June, it's sold off, but it's more or less looking like it's consolidating at this higher level. I know there are still some dollar bears out there. There are also these dollar bulls. It's really a coin flip depending on who you talk to. Where do you stand with the price action we've been seeing in the dollar for, you could say, the last about 2 to 2.5 months?
Well, at this point, Corey, I think you have to lean bullish. I just don't see any reason for a bearish argument with respect to the price action. I mean, the big overriding thing that we've talked about is the fact that when the dollar was going down last year and it made two new lows, precious metals, gold, was unable to make a new high. So that was a strong non-confirmation that happened twice. And so on the flip side, now that the dollar's been rallying, we saw this strong move up to 95, and there's a confluence of very strong long-term resistance just below 96 there in the mid 95s or so. And the dollar got up to 95 at the end of May. And since then, it has been consolidating basically between 93 and 95. I mean, it touched 93 at the beginning of its correction, but then zoomed higher to 95 again. And 3 or 4 days ago, it looks like it made a low around 93.50. Today, it's up half a point to 94.43. So it's nearly half a point within that high around 95. So far, I mean, over the last 6 weeks, we could say this looks like a bullish consolidation. I mean, it's holding above all the long-term and short-term moving averages. I know the 200-day, I think it's around, I want to say 92 or 93, but also the 200-day moving average, its slope is now higher. So that when you see the moving, it's really the direction of the moving averages that are important. So the rebound that we've had in the dollar managed to surpass the 200-day moving average, but also as of now, the 200-day moving average is now sloping higher and the dollar is above it. I don't know if the dollar is ready here to break through 95 immediately. It probably needs a little bit more consolidation, but yeah, Corey, here and now, I mean, I think you have to be a dollar bull. The path of least resistance to me eventually looks like it's going to be higher.
Hey, even on those weekly charts, the moving averages that I watch, they are all still also turning up, and that's recently after that 50-week moving average just made its bottom and now is starting on that positive trajectory. I also want to talk about this 95 level, or in around this 95 level for the dollar. It's where the bounce in the tail end of 2017 petered out at, and it's also pretty much the level where the run this year so far has petered out at. Above this level, though, there's quite a bit of air. Can you address this comment?
Yes. Well, if we're looking at the price action of the dollar, it's made a clear, I don't want to say it's a head and shoulders pattern. I mean, I don't want to get too technical because this is a pattern that it shows up on charts literally, I don't want to say all the time, but it shows up on charts quite often. And you have a lot of people labeling these things head and shoulder patterns without really knowing the true fundamentals of what's supposed to happen in these patterns. But regardless of if whether it's a head and shoulders pattern or not, the key thing is 95 is a key level, and that's a potential neckline. And with the dollar bottoming, we could say at 88 or just below it, you're looking at, if the dollar makes a clear break above 95 and that's sustained, you're looking at a potential 6.5 to 7 points of upside, which would take you to 101 to 102. And Corey, the fact that the dollar has spent a lot of time below 95 since it went below it in the about 12, 13 months ago, the more that the dollar would consolidate here, if it consolidated for another month or 6 weeks, that's setting up more energy for it to make a big move higher if it's able to break above 95. And so getting back to the potential pattern and the potential measured target, a clear, clean break above 95 is going to take the dollar to 101, maybe even 102. And that is above the 2015 and 2016 peaks. So I'm not saying a break above 95 is imminent, because looking at the weekly chart, there's still a little bit of resistance there at 95. It might take a little bit more time to break through it, but you're correct that if it does break above 95, I don't see there being much resistance, much that's going to stop it from reaching 101 to 102.
Okay, that was going to be my next question, is that you do see, or you can see maybe in the longer term picture, the dollar getting into triple digits again.
Yes, I mean, I would think it's likely now, and with a strong break above 95, I have to say it's very likely.
Okay, let's move over to the S&P, because you have even made a comment that you think the S&P 500 is more important for the precious metals than the U.S. dollar. The S&P, looking at a weekly chart, to me at least, still looks quite strong. Yes, it's getting hit today, but it's right about at this level where the recent bounces have topped out so far this year. Right above that level, though, is the next all-time high. What do you think? S&P, strength here?
Yes, I agree. And I mean, there's been some indices in the U.S. that have already made new highs, like the NASDAQ and the tech stocks, the small caps. So there's already some segments of the market that have been able to make new highs. And so the S&P 500 should follow, even though there's some tiny breadth divergences where some sectors are struggling. But aside from that, if you're just looking at the pure price action on the S&P 500, it's been able to hold above the 200-day moving average essentially 3 times since the beginning of the year when it tested it. That moving average is sloping higher, and the S&P 500 has been comfortably above it in the last couple months. It's still above the 50-day right now. So even though there is some resistance around 2,800, the dollar in recent months has been trending up. It's above the moving averages. The corrections have been getting smaller. So it's building up energy to be able to break above 2,800. And if it breaks above 2,800, I definitely think it's going to be able to run to a new high above 2,900 and maybe 3,000 in short order. And with respect to, I'd just like to touch on what you mentioned there so the listeners can hear my rationale for why I think the S&P is more important than the dollar. The reason is, if you're looking at real bull markets in gold and precious metals, the only time that gold and gold stocks had a decent bull market where it wasn't outperforming the S&P 500 strongly during said bull market was 85 to 87. And that was a 3-year bull. And the dollar it was down like 50% during that bull. There was a massive decline in the dollar, and there was a decent bull market in gold and gold stocks, but nothing like we had in the 2000s. So other than that period, all the bull markets that we've had, the strong, the best bull markets in precious metals, they have occurred while precious metals have been clearly outperforming the stock market. And if you look at a chart of precious metals and then you look at gold versus the S&P 500, you go through history, you can see that in recent years, gold has not outperformed the S&P 500. So I mean that's a major divergence. And the fact is, Corey, I don't want to get too far down the rabbit hole here, but the fundamental driver of gold is negative or declining real interest rates. And usually we get that policy when the economy is in a recession or the stock market is weakening. And so that's why at times you have a negative correlation between the stock market and gold. And I've been saying in recent years that that's what we really need to spring a bull market in precious metals. A real bull market is we need to see the S&P 500 go into a bear market. We probably need to see a recession. And look, until that happens, the Fed is going to, as long as the market's moving higher, the Fed's going to continue to hike. And when there's a problem and when that stops, the Fed will stop hiking. If the market goes down more, they'll move to cuts. And when they stop hiking, that's when gold is going to bottom and start rising. Now, as for the dollar, I mean, there's certainly periods short-term periods where if the dollar goes down, yes, it's going to help gold, but ultimately, right now, in the bigger picture, it's more important for precious metals. If they're going to have a real bull market, it's more important for the stock market to go down than the dollar. I mean, let's just go back to the last year or two, Corey. The dollar had this massive decline. It made 2 new lows since gold had that 2016 peak. And what happened? Gold couldn't break out. Silver and the gold stocks have performed terribly since then. So, I mean, it's quite clear if you're looking at this carefully over the last couple of years and you're studying history, the stock market is the key to springing this new bull market in precious metals. It's not the dollar.
I absolutely agree, and that also does, again, tie to what central banks do. But first and foremost, we need to see some more weakness in the U.S. equity markets, and it's just not right there right now. And that's even in the face of a lot of question marks around the world. Let's also talk about GDX and GDXJ. They are getting hit quite hard today, actually, continuing their sell-off as we're recording this. They're down at least 2%. GDX is down about 2.3%. This comes after our discussion last week when we talked about the overall breadth within these ETFs not being very strong. The sell-off that we're seeing today in the face of a down gold price, it's still not breaking down below that trading range that these ETFs have been in for now coming up on almost 2 years. But general weakness just continues to scare and shy investors away from the market, doesn't it?
Yeah, I mean, it really is. And you're talking about investors. And look, because when precious metals are going to go into a bull market, or when they or what they need to go into a bull market and really run like they did in the last decade, they need the marginal buyers, the people who are not gold bugs and bulls, the people who don't normally invest in or follow this stuff. And they see the stock market. These investors, they see the stock market moving higher, trending higher, and the gold stocks are just going nowhere. That's just, I mean, that's not encouraging to them. That's not making them think, well, I need to invest in gold stocks right now. That's just not going to happen. And I mean, it's a little surprising, Corey, because I thought that, maybe the gold stocks could push a little bit higher. I mean, they're given where sentiment is, we're set up to have a decent rally for at least a month, but the metals have been very weak. I mean, they've retraced most of their gains already, and the same could almost be said for the miners. So I'm at a loss for new words here, Corey. I mean, it's just the ranges have been getting tighter and tighter, and they're really just going nowhere. And if you're investing in the stocks, it's a stock picker's market.
And that's just the way the market is right now. I totally agree. And I think, as you just pointed out earlier with the S&P comments, it's going to take a general shift in terms of what central banks are doing for the metals to really get running. But on the flip side of this, Jordan, you're not necessarily thinking we're going to go through a major breakdown in the metals, do you?
Well, not yet. I mean, I think sentiment is fairly negative, and I think that needs to be reset before there's potential for the metals to have a bigger decline. But once we kind of pass this month or the next month, we do need to be on guard for a potential decline, because we were talking about the dollar, and if the dollar does make that strong breakout above 95 to 101, 102, that's going to put a lot of downside pressure on precious metals. And a big reason for that, which we may or may have not discussed in recent weeks, is gold against foreign currencies put in a clear top and reversal about a month or so ago. And then, so when you factor in that gold is now not showing strength against foreign currencies, and it remains very weak against the stock market, that means it's even more tied to the movements of the dollar. And so that's something that worries me with respect to gold and silver over the months ahead, is that the potential for the dollar to have this strong move above 95 and get to 101 or 102. If that is going to happen, that's going to put a lot of downside pressure on the metals. So am I concerned about the metals having a big decline here over the next 3, 4, 5 weeks? No, not really. I think sentiment is too washed out for that to happen. But as we move beyond that period and we get to the end of summer and into the fall, I am concerned that there's potential for that kind of a downside move. And I'll just throw in one more thing, Corey. because a lot of other people talk about seasonality so often. But if you look at the last 5 years in this sector, 4 of those 5 years, the sector had a big move down that basically started in either, I want to say it had, what I should say is 4 of the last 5 years, the sector had a big move down either in August or September. So, one problem with seasonality, Corey, is people are showing these 30 or 40-year charts of gold, and that doesn't really make any sense because there's a clear difference between seasonality in the last 5 years and then the last 40 years. Because if you're looking at like seasonality of the last 40 years of gold, you see kind of an uptrend for the whole year. I mean, yeah, there's a few stronger periods than others, but you're taking into account the fact that gold was at $35 an ounce 40 or 50 years ago, and now it's at $1,200. So it looks like there's going to be certain strong periods during the year. But if you look at the last 5 years, it's pretty clear that the seasonality of the last 5 years is completely different than the other periods. So what really matters, Corey, is what's the overall trend in the market more so than seasonality. And if you look at the last 5 years, that shows you that the sector has had a very strong tendency to be very weak in the second half of the year. And I mean, that weak seasonality has gotten underway with a major decline happening in either August or September. So that's just, I know we're going too long on time, but that's another thing I wanted to throw in because a lot of conventional seasonal analysis is not even taking that into account, what has happened in the last 5 years, especially at the end of the summer. It has not been good for the sector.
Interesting comments there, Jordan. I always appreciate the way that you can break down what we're seeing and compare it to some of what we've seen in the past and also decipher how some things are very different right now for this overall metals sector. I know this has probably come off a little bit negative, but quite frankly, you've brought up some very good points that people do need to consider. Jordan, I hope you have a great rest of your week, and we will be chatting again next week.